Hi everyone, FXLeaders.com. We're back in action. If this is your first time, I'm Levine, cryptocurrency head analyst here at FXLeaders.com. And this is your go-to channel for learning how to trade Forex without all the complicated jargon that comes with it. So far in this series, we've covered what Forex is and how to read those sometimes weird looking Forex quotes. If you haven't watched those yet, make sure to find those links somewhere around and cover that because today we're answering a question every beginner asks, which is what actually makes Forex prices go up and down, right? Spoiler, it's not magic. It's all about economics, news, and market mood, also known as market sentiment. So, if you're ready for it, hit that subscribe button and let's dive straight in. At the simplest level, guys, currency prices move based on supply and demand. If more people want to buy a currency, its price goes up. If more people want to sell it, the price goes down. That's pretty simple, right? Let's use an example. If a strong US job report comes out, more traders will buy the US dollar. However, if a major economy like Japan reports weak numbers, people might go and sell the Japanese yen. It works just like any market. More demand, higher price. More supply, lower price, right? The challenge is figuring out what makes traders want to buy or sell a currency. And that's where economic factors and news come in. What you're seeing on your screen right now is a classic example of just a normal calendar, news calendar on a daily basis with all of those economic data that's coming in by the hour, and they have an impact on the prices in the foreign exchange market. Let's break some of these economic data, economic events, so we can understand better what those type of events really have big impact, really moves the market. And these are really the big ones, right? Take a look on the right side of the screen. You can see the list of the big ones. So we're talking about interest rates. That's the biggest, right? If there's if a data's coming in and it doesn't match the expectation, it's gonna move the market, right? It's gonna have a big impact. So as far as interest rates goes, when a country raises its interest rate, it usually strengthens that currency. Why? Because investors want to move their money to countries paying higher returns. Second one is inflation, which, moderate inflation is healthy for an economy, but high inflation eats away, right? So that could be a serious impact if it comes out of proportion, right? Above expectation, especially. And you can see here on our calendar, on our event calendar on the left side, you have the actual data that's coming in, right? Here we had earlier in the morning today, we had Cleveland Fed inflation expectation. You can see the actual number. It's 3.9%. Later at 11 a.m., federal budget balance came at 258.4 billion, right? But here's the interesting part here. So we have the actual data, but we also had the forecast for it, right? And we had the previous, so we can see the trend. But what's really make a strong impact here is the difference between the actual number and the expected number, right? The one that's in the forecast. So here we can see the actual number came slightly higher than expected. More important economical events that I can mention are employment data. Stronger job numbers equals growing economy, stronger currency, right? And vice versa. Weak job report, failing confidence, weaker currency as a result. GDP growth, of course, that's a big one. A growing economy strengthens its currency because it attracts investor and boosts trade, right? So keep an eye on those economic calendars like Forex Factory, for example. That's a good one. That's a go-to for me. Or your trading platform's newsfeed, because those big announcements do make a difference. But hey, news isn't just about economics. Elections, war, trade deals, and political chaos can rock currency markets, and it does every now and then. A classic example, Brexit, right? A few years ago, when the UK voted to leave the EU, the British pound dropped like a rock overnight. So, why? I mean, I guess the answer is markets hate uncertainty, right? That's key. And when traders get nervous, they rush into safe haven currencies like the US dollar, Japanese yen, and Swiss franc, for example. That's why you'll sometimes see massive moves on random breaking news. Central banks like the US Federal Reserve or the European Central Bank controls interest rates and intervene in markets when necessary. That's important to notice. A simple announcement or speech from the Fed chair can move the US dollar instantly. All right, so keep an eye on that one as well. When central banks raise rates, it usually strengthens their currency. When they cut rates, it weakens it. Always check for scheduled speeches and policy meetings on your economic calendar. Finally, let's talk about market mood. Sometimes it's not about data, it's about how traders feel. When traders feel confident, they buy riskier currencies like the Australian dollar, New Zealand dollar, and Canadian dollar. When they get nervous on that, kind of a risk-off mood, they would rush to safer currencies like the US dollar, Japanese yen, and Swiss franc. A stock market crash, for example, would trigger a rush into the US dollar and the Japanese yen almost immediately. And there you go. Those are the main forces moving the Forex market. Let's have a quick recap. Talking about supply and demand, economic data, political news, central bank actions, market sentiment also. Now, if you learned something new today, hit that like button, drop a comment below, let me know which factor surprises you the most, which factor draws you the most maybe, and subscribe to the channel. That's about that for this one. Looking forward to see you in the next video, guys. Take care.